Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to tell you how you can avoid investing in corrupt, poorly managed companies without integrity. Nothing can sink a company and all of its investors quite as fast as corrupt management. Management with neither talent nor integrity. And you don't have to look very hard to find examples of CEOs and other executives who sent their companies into a tailspin due to shady deals and ethically questionable behavior. And this is why management is one of the 4 M's of Rule 1 investing, and an important one at that. And sometimes, though, it can be very difficult to know whether a management team is trustworthy and has integrity. In this video, we'll take a look at a few tips you can use to highlight untrustworthy management and avoid investing in corrupt companies. Okay, so first, are the company founders part of its management team? As a general rule, the people, the men and women who originally found the company, the ones who started it, are much less likely to be corrupt than somebody who's hired on as a mercenary to run that company. And there's a couple reasons why this is the case, starting with the fact that the founders of a company normally have a very large financial stake in its success, much different than the small stakes of a normal management team. They can't afford to engage in corrupt behavior. Why? Because it could bankrupt the company, wipe out their ownership of the company, and send it on down the stream to some other organization they don't own. In addition to this, most founders are incredibly passionate people about the company they started, and they wouldn't want to do anything that poses a risk to it. Now, of course, these are just generalities, and there are most certainly founders out there who are exceptions to the rule and who kind of push the edge of things, especially when it comes to creative accounting. They can be a little tricky about maybe talking about adjusted EPS, about pushing it over the line on what they're doing on a quarter-to-quarter basis to try to support their stock. Okay, that ain't great, and it's not a great sign, a little bit of a red flag. But in general, if the founders of a company are part of its management team, it's usually a good sign. Second thing is, are they managing debt correctly and with integrity? How management goes about managing a company's debt says a lot about their integrity. If a company's management is using debt as a way to artificially inflate their numbers and make it more attractive to investors, you should really red flag that and avoid putting your money into a company that does that at all costs. Now, one of the main ways that management sometimes uses debt in this manner is by adding size to the company, but not increasing the company's return. Since executives are often based on a company's assets rather than its returns, or its revenue rather than its earnings, for them to line their own pocketbooks, one of the best ways to do it is to just go buy more companies. Buying more companies makes them bigger, and they get a bigger jet. So this is a real red flag if return on equity and return on invested capital are not staying high when this management team is using debt to increase the size of the company. Third, does the management team have a serious personal stake in the company's success? Never invest in a company that's run by executives who don't have enough faith in their own company to invest their own money in it. If an executive does not have a significant portion of their net worth invested in that company's stock, not only are they showing bad faith in the company that they run, they also have little incentive to grow it and ensure that it is successful in the long term. And then they start going for short-term incentives, and that can ruin the company. In other words, executives who have no stake in the company's success are just there collecting a paycheck, and this is almost always a recipe for disaster. Good executives will trust their own company and their own ability to grow it enough to put real skin in the game. And if they don't have a large portion of all of that money we're paying them every year stuck into that company's stock, then why should they expect you to invest a large portion of your money in that company's stock? Fourth, is this management team trustworthy, in particular the CEO? Trustworthiness and integrity, that's the most important factor to consider when evaluating the management of a company. Warren Buffett says, I want them to be like people that I would want to be married to my daughter. I want them to be like son-in-laws or daughter-in-laws. It's also one of the most difficult things to analyze because we, unlike Warren, don't get to go have dinner with the CEO. So after all, It can sometimes be pretty hard to determine the trustworthiness of people you're close to, even having dinner with them, much less people you've never met. Now, with that said, there are some things you can look at to determine whether or not a company's management team is trustworthy. Start by doing this. Take a look at their past career. It'd be great if you see that it's been squeaky clean, free of scandal, they haven't taken companies down the tubes, they haven't screwed over some other group of investors. However, if that executive was willing to engage in corrupt behavior in the past, chances are they're willing to do it again, right? Character is what you do under adversity. Now, don't expect them to behave differently when adversity strikes. Next, take a look at the all-important letter that the CEO sends out to shareholders. These are sent out once a year and are their only time when the CEO can communicate what's really going on in that company to the people who own it. So read the letters back several years and ask yourself these questions. Is the CEO being honest about the state of the company? Is he willing to let the shareholders know about both the good things that the company's doing and the bad things that it did that they're going to correct? Or do they treat the shareholder letter like it's a sales pitch or like it's some kind of little message out to all of the employees about how wonderful the CEO thinks they've been doing? If it's that latter thing, the CEO is essentially lying to the shareholders, and he's lying to the public at large in order to shore up, maybe sell more stock. And I'm telling you, this is a huge red flag. A wonderful friend of mine named Laura Rittenhouse has written a great book called Reading Between the Lines. Get this book. It is her method, so great. Her scoring method on the corporate CEO's annual letter that lets you understand how the language the CEO is using is being used either to give you the truth or to mislead others. As Warren Buffett once said, if a CEO is willing to mislead others in public, they're probably willing to mislead others in private as well. Be sure you get Laura's book. It is fantastic. And by the way, Warren Buffett recommends the book, one of the few books he really strongly recommends, and he's a personal friend of hers. So definitely get it. It's maybe the best tip to figuring out what's going on with those CEOs. Now, I'd love to hear from you guys. Have you ever been burned by a company with corrupt management? I have. So leave a comment below with your answer, and I'll be sure to follow up with you. Thanks for watching, you guys. Now go play. If you enjoyed this video and you feel it was valuable in teaching you more about how to avoid corrupt companies, hit the like button, and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click on the button on the screen for a free gift. And thanks again for watching.